Hey everyone, welcome back to Power of Investment. If you're looking to step up your trading game and unlock some powerful futures trading strategies, you've come to the right place. Today, we're diving deep into strategies specifically tailored for Nifty and Bank Nifty futures. Whether you're a seasoned trader or just starting out, the insights I'm about to share could be the game changer you need to boost your trading success. First, we'll cover the theory behind each strategy, and then I'll show you how to apply them in real trading scenarios. So stick around. This could be the most valuable trading lesson you've ever had. In this video, we'll dive into mastering futures trading strategies, focusing on trend following and mean reversion techniques. Section 1. Trend following strategy. Let's kick things off with the trend following strategy. You've probably heard the saying, the trend is your friend. This strategy is all about riding the market's direction, whether it's up, bullish, or down, bearish. Let's break it down step by step. Step 1. Identify the trend first. You need to identify the trend. This is where moving averages come into play. Apply a simple moving average or an exponential moving average to your price chart. For short-term trends, use a 50-day SMA. For long-term trends, go with a 200-day SMA. Here's the trick. If the price is consistently above the moving average, you're in an uptrend. If it's below, you're in a downtrend. Step 2. Confirm the trend. To confirm the trend, you'll want to use additional indicators like the relative strength index or the moving average convergence divergence. An RSI above 50 suggests a strong uptrend, while below 50 indicates a downtrend. A MACD crossover, where the MACD line crosses above the signal line, can also confirm a potential trend. Step 3. Enter the trade. Now let's talk entry points. In an uptrend, buy when the price pulls back to the moving average or hits a support level. In a downtrend, sell when the price rallies up to the moving average or hits resistance. Step 4. Set stop loss and take profit levels. Always protect your trades by setting a stop loss order. Place it just below the recent swing low in an uptrend or above the recent swing high in a downtrend. For take profit, aim for a risk-reward ratio like 1:2 or 1:3. Step 5. Manage the trade. As your trade moves in your favor, consider using a trailing stop loss to lock in profits. Keep monitoring your indicators for any signs of a trend reversal. Step 6. Exit the trade. Finally, exit the trade if the trend reverses. Look for signs like the price crossing the moving average in the opposite direction or your indicator signaling a reversal. Section 2. Mean reversion strategy. Next up is the mean reversion strategy. This one's all about betting on the market, snapping back to its average or mean price over time. It's particularly effective in range-bound markets. Let's break this one down. Step 1. Identify overbought or oversold conditions. To spot overbought or oversold conditions, you'll want to use indicators like the RSI, Bollinger Bands, or the stochastic oscillator. An RSI above 70 signals an overbought market, hinting at a potential sell. An RSI below 30 signals an oversold market, hinting at a potential buy. Step 2. Confirm the mean reversion setup. Next, apply Bollinger Bands to your chart. If the price touches or crosses the upper band, it might be overbought. If it touches or crosses the lower band, it might be oversold. Also, look for price action that deviates significantly from the historical mean, like the 50-day SMA. Step 3. Enter the trade. In an overbought condition, consider entering a sell position when the price starts moving back toward the mean. In an oversold condition, consider by entering a buy position when the price begins to revert to the mean. Step 4. Set stop loss and take profit levels. Place your stop loss just beyond the recent high in an overbought condition or below the recent low in an oversold condition. For take profit, set your target near the mean or the moving average. Step 5. Manage the trade. As the trade moves towards the mean, keep an eye on the price action. If it stalls before reaching the mean, consider closing the trade early. Adjust your stop loss as the trade moves in your favor. Step 6. Exit the trade. Close the trade once the price reverts to the mean. If momentum continues in the direction of the reversion, you might hold the position a bit longer. But be cautious, as momentum can shift quickly. Section 3. Mean reversion strategy. Now, let's dive deeper into a specific mean reversion strategy using the Relative Strength Index, or RSI and MA moving average. This is a powerful combination for spotting potential market reversals. We'll break it down step by step, starting with the theory behind RSI. Tools required for this strategy. We will use below tool in this strategy. MA moving average understanding, RSI. RSI is a momentum oscillator that measures the speed and change of price movements. It ranges from 0 to 100 and is primarily used to identify overbought or oversold conditions in the market. Overbought is when RSI goes above 70, often indicate that the asset is overbought, suggesting that it might be due for a correction or pullback. Oversold is when RSI drops below 30, suggests that the asset is oversold, implying that it could be poised for a rebound. The orange line represents the EMA, exponential moving average, which acts as the mean or average that the price tends to revert to. When candlesticks move significantly above the EMA, the asset may be overbought, while significant moves below suggest it may be oversold. After deviations, the price often reverts to the EMA, as seen around mid-April and mid-June, when the price fell below the EMA and then rose back toward it. Similarly, in late June and early August, the price rose above the EMA and then pulled back. Trading strategy. Traders use these deviations for decisions. If the price is above the EMA, they might anticipate a drop and consider selling. If it's below, they might expect a rise and consider buying. Identifying the trade. Here's how to spot your trade setup. Bullish setup. Look for the RSI to drop below 30, indicating the asset might be oversold. Also, watch for bullish divergence, where the price makes a new low, but the RSI makes a higher low. Bearish setup. When the RSI rises above 70, it indicates the asset might be overbought. Look for bearish divergence, where the price makes a new high, but the RSI makes a lower high. When to enter? To time your entry, bullish trade. Enter a long position when the RSI moves out of the oversold zone and you see confirmation with a bullish candlestick pattern. Bearish trade. Enter a short position when the RSI moves out of the overbought zone with confirmation from a bearish candlestick pattern. Setting the target and stop loss. Targets and stop losses are crucial. For a bullish trade, set your first target at the next resistance level or around the 50 RSI level. For a bearish trade, target the next support level or around the 50 RSI level. Place your stop loss just below the recent swing low for a bullish trade or just above the recent swing high for a bearish trade. Setting up the indicator. Open up a daily chart of the futures contract you're interested in. Let's say Nifty futures. Apply the RSI and EMA indicator with the default setting. This is where the magic happens. Managing the actual trade. To understand how mean reversion works on the above chart, using both the RSI and EMA, let's break it down step by step. Identifying a potential trade, entry price, target price, stop loss, and calculating the risk-reward ratio. The above chart is a candlestick chart of the Nifty index, with a 5 days exponential moving average and a relative strength index indicator at the bottom. Chart analysis. Exponential moving average. The orange line represents the 5-day EMA. This moving average acts as a dynamic mean around which the price oscillates. Relative strength index. The RSI at the bottom of the chart helps identify overbought and oversold conditions. Identifying a trade. Observation. In early June, the price sharply dropped below the EMA and the RSI also showed oversold conditions. The RSI then formed a bullish divergence, marked by the green line, where the RSI made a higher low, but the price made a lower low. This divergence signals the selling momentum is weakening and a reversal might occur. Entry point. Price 21,600 on 4th June 2024, where the bullish divergence was confirmed and the price started to recover. The entry would be made after observing the price bottoming out and the RSI starting to rise from oversold levels. Target price 22,600. It aligns with where the EMA catches up with the price as it reverts to its mean. And then 23,300, 23,300. This is the level where the price last peaked before the drop, and the target price is based on the prior resistance level. Stop loss. Price 21,200. This is slightly below the recent low of 21,282. Setting a stop loss just below this level protects against further downside if the mean reversion does not occur. Risk-reward calculation. Risk entry. Price 21,600. Stop loss 21,200. Risk per share 21,600 minus 21,200 equals 400 points. Reward. Target price 22,600. Entry price 21,600. Reward per share 22,600 minus 21,600 equals 1,000 points. Risk-reward ratio. Risk 400 points. Reward 1,000 points. Risk-reward ratio 1,000 divided by 400 is approximately 2.5 to 1. Trade summary. The trade identified is a bullish mean reversion setup based on the combination of price moving back towards the EMA and the RSI recovering from oversold levels with a bullish divergence. The calculated risk-reward ratio of 2.5:1 is highly favorable, meaning for every point of risk, there's a potential reward of 2:5 points, which is a strong proposition for this trade. This analysis provides a structured approach to identifying and executing a mean reversion trade, using AMA and RSI as the key indicators. Conclusion and what's next. So there you have it, the mean reversion strategy, using RSI plus EMA and how you can use it to spot potential trades in the futures market. Mastering these strategies can really help you enhance your trading performance and navigate the market with more confidence. Unlock your financial potential today. Visit powerofinvestment.co.in and start mastering the strategies that will secure your future wealth. Don't miss out on transforming your financial journey. In our next video, we'll be discussing a trend-following strategy. So make sure to stay tuned. If you found this video helpful, don't forget to like, share, and subscribe. Thanks for watching, and see you in the next lesson.